mirror image of this particular chart that you see here. So when you short a call, when you sell a call, you receive $5 for selling a call, which means you're giving somebody the right to buy shares from you at a price of $100. So if the price is below 100 in future, then nobody will exercise that option. You make a profit of $5. So you can see when you sell a call, your profit is limited, but your loss can be unlimited. So if the stock price tomorrow goes to $200, you will have to buy the stock at 200 and sell it to the person who bought this call option from you at $100. So your profit can be is limited and your loss can be unlimited when you sell a call option. So this is a short call position.
The strike price and exercise price are the same thing.
Yeah, they are the same thing. Sorry.
And the short call is basically a contract to be able to sell at a predefined price.
No, short call means you're selling somebody this option.
Yeah.
So when you sell the call option, that person to whom you're selling the option has the right to buy the stock at $100. And now you're obligated to sell the stock at $100. So when you buy the option, you have no obligation. But when you sell options, you become obligated. So
there's a question from Kiran. She's saying, if the profit is limited and loss is unlimited, why is this a good trading strategy?
Yes, so I'll talk about a case where you can actually have the stocks already in your portfolio and you will sell call options to make premium. So thanks, Karan, for clarifying. So I'll show you a strategy. Just give me like another 5 minutes. I'll show you a trade I made just last week. Why am I selling call options and why that is a good strategy. But that is called as a covered call strategy. When you already have 100 shares and you're willing to sell the stock at a certain price and you sell call option to make premium. So that's the answer to the question. So like we can have a long put position. So we buy a put option with a strike price of $70 and we pay $7 to buy this option. We'll break even at a price of $63 and our maximum profit will be $63. That is when the stock goes to $0. So when the stock goes to $0 and you can still sell it for 70, that's when you have the maximum profit. So you can buy it from market at $0 and sell it at 70, and you paid $7 for this option, so your profit is going to be $63. And the payoff,
so in terms
you're
of
buying a put option. So long put means you're buying a put option.
And a put option is the ability to sell something at a predefined price. So I basically bought the ability to sell something at a strike price of 70.
Yeah, so people do this to hedge their portfolio. So let's say I have 1,000 shares of Tesla and I don't want to, let's say, sell the stock right now because I'll have to pay taxes in December, let's say. So I want to sell them in January, so delay paying the taxes on my capital gain. But what if the stock price goes down in December by 30, 40%? So what I can do is I can buy put options for Tesla stock with a strike price, let's say, which is slightly below today's price. So let's say today the price is $950 and the maximum loss I'm willing to take is $50 per share. So I'll buy a put option with a strike price of $900, which expire in January. So then I'm protected. What if the Tesla stock goes down to 500 in January? I'm still okay because I have the right to sell the stock for $900.
Almost like buying insurance. So if you don't end up selling, then you will actually lose the money that you spent on buying the options.
Yeah, but you are insured. So you're right. And I also talk about a strategy where you can try to cover the cost of the put option that you're buying. So that'll be in a couple of slides.
So Kiran is saying long is equal to buy and short equal to selling. And there are two kinds of options. It could be a put option or a call option.
Yeah, so you can have a long position in both put and call, and you can have a short position in both put and call.
The long and short is basically, are you buying something or selling something? And a put and a call is, what does that contract give you?
Yeah, it gives you the right to buy or right to sell. Yeah, that's right. So I'll give you again a speculation example. So let's say you had $2,000 to invest and you think that stock price will go up over the next 2 months. So the stock that you're trying to buy is $20 and you can either buy 100 shares or you can buy call options with a strike of $22.50. And the price for those options is $1. So you can do two things with this particular example. So you can buy 100 shares. So that is one option that you have. So what happens when you buy 100 shares? And the other option is you buy 20 option contracts. Because each contract is for 100 shares and the price is $1, you can buy 20 option contracts. So let's say the stock price in future is $60. So what is my profit here? So my profit here is 60 minus 20 times 100 or $4,000. And what is my profit here? My profit here is I can buy 2,000 share at a price of $22.50. So that is the payoff from my option. And I have to subtract the initial cost of buying those options. So that is $73,000. So of course, you have to be right about the direction in which the stock is going to go up. So you can see in one case, you got a profit of $4,000 by investing $2,000. In the other case, you got a profit of $73,000. But what happens if the stock price in the future is $15? So in this case, you lose $5 per share, so your profit is negative $500. But in this case, you lose everything because your option is worthless now, so your loss is $2,000. So you can lose all your capital when you're buying these options, which you won't in the case of shares unless the stock went to $0. So that's one example of leverage I wanted to give you. So after this, I want to talk about, and again, we already talked about expiration date and strike price. You already have an idea. So I want to give you an example of what you can do with these options. So let's say there's a stock that you already like, right? And you want to buy it. So what you can do is you can place a limit order to buy it. So let's say Tesla is trading at $950 and I'm willing to buy at a price of $900. So I can sell put option with a strike price of $900. So I can give somebody the right to sell the stock to me for $900 and that premium I receive is going to be my profit. So here's an example of what Warren Buffett did. So years ago, he wanted to buy Coca-Cola. So Coca-Cola at that time was trading at $39. And he wanted to buy it for a price of $35. So he just sold 50,000 put options contract, which represent 5 million shares. And those contracts were trading for $1.50 per share. So he made a profit of $7.5 million right away. So if the stock price did not go down to $35, that is his profit. If the stock price goes down below $35, he'll have to buy it for $35, but that he wanted to anyways, right? So you can enhance your profit by selling these put options. So I'll give you an example of what I do. So this is a trade from my own portfolio. So a few months ago, Spider, which is an ETF for S&P 500, so which is considered safe. So let's say if you want to start investing in stocks, it is a good idea to start with Spider. So Spider a few months ago was trading at $450, right? So at that point, I thought that if Spider falls by another 10 or 12%, I'll be happy to buy it, right? I like to buy when prices fall. So I sold 10 contracts of Spider at a price of, if you see my mouse here, at $9.23. So which means I got $923 per contract. And because I sold 10 contracts, I received $9,230. Now, and this option was expiring in January of 2022. So at that point, when I sold this option, it was trading for $9.23. And this is called as out of money option, because at that time, Spider was $450 and I'm willing to buy at a price of 400. So that option has no intrinsic value for the buyer. They will not sell Spider for $400 when it is trading for 450. They're buying it as a hedge, that what if the stock market goes down? I want to have some put options in my portfolio. So now, right now, yesterday or this morning when I took this screenshot, this option was trading for $1.14. So if I want, I can buy this option back to close my position and I'll have a profit of $8,080. But I'll just let it sit until January of 21 and 2022. And if Spider value does not go below 400, right now it's trading at 470. So the chances that will go below 400 are very low. And this $9,230 is going to be my profit. So this is called as writing cash secured puts. So if you already know a stock that you're bullish about, or you're interested in buying, it's a good idea to sell put options of that stock. If the stock price goes below the strike price, you'll have to buy the stock at that price, which you are anyways okay with. And if the stock price does not go to that price, the option will expire and all the premium is your profit. So this is called as writing cash secured puts. So this is what I do a lot. And I think it is less risky. So you need to have the margin in your account to actually buy the stock if actually Spider goes down. So let's say if I actually did not have the money to buy 1,000 shares of Spider and Spider goes down to 300, yes, then I'll have to book a loss. I'll have to buy this option back at a loss because I do not have enough money to actually buy these shares. So that's not a good idea to do it if you do not have the cash to actually take the delivery. So let's say you only have $40,000 in your portfolio, then sell one contract. Let's say if you have $20,000 in your portfolio, then you can still sell one contract if it is a margin account. And let's say you say, I do not have $20,000, I only have $5,000. Then you can sell put option on a stock that is trading for $50 and that you still like. So you can sell put options for stocks that are low in price, so you pay a lower premium, and they'll still be cash secured puts because you have the cash to take the delivery. So is that making sense to you, Khushbu?
Mostly. I think that's a lot of information. I'm not sure where our audience is. For me, I'm like processing quickly and trying to learn. But yes, it does make sense that if you're bullish, you can actually write a cash secured put. So you're basically bullish and you're saying, hey, if somebody else wants to insure a hedge, I'm actually selling the hedge.
Yeah, so actually this is what happens in the insurance industry. I mean, insurance companies are making a profit on average, right? And because they are giving me a service. So same here, I'm writing cash secured puts. People have the stock in their portfolio. They want to hedge their portfolio. Or there might be people who are actually bearish on the stock, which is okay, right? Some people will be bearish, some people will be bullish. So I'm writing puts for stocks that I'm willing to buy. So this is one way of generating income, and it is less risky. So these strategies that I'm talking about are simpler, actually. I have some of the strategies later on in the slides that we may or may not go over today. But if this strategy makes sense to everybody, and let's see if people have questions.
Yeah. There are some questions. I do have one thing, though. I was hoping you would talk a little bit more about the whole concept around margin trading and what are the eligibility requirements? How much should I be staking? Are there systems in place to prevent me from actually trading more than I can afford to, things like that?
Yeah, so if you do not have the margin account, your broker will not let you use the margin. So you will need to have $400 or $40,000 in your account if you're selling one Spider put. But if you have, as long as you have enough money to buy those shares, all 100 shares, you do not need any other risk protection strategy or any other cash because you are not using margin. But let's say if you're using margin and the stock price keeps falling, there might be liquidation. So that's true. So you need to have maybe some extra cash in your account and not rely completely on margin. So let's say that your broker gives you 50% margin. So for buying $40,000 worth of share, you are putting only $20,000 of your money. And then if the stock goes down to 300, you might get a margin call. So you should always have more than what is the minimum requirement for buying that stock.
So you can either buy with your own cash or use the margin account. But in the margin account is something that your broker dealer will make happen.
Yeah, and also the stock keeps falling, you might get a margin call to put more money in, and if you do not, then they will sell your position. So that's a risk.
What happens in that case? So if you didn't have the cash and you were hoping, like, if what happens in a scenario where things go south, typically?
Yeah, then they'll sell your position at a loss, which you did not want to, right? So
if you had money I put in, basically.
Yeah, so if you had the cash, 100% cash, then that position will never be liquidated, and then you can wait for the stock to bounce back up. But if you were using margin, actually the stock price falls and your position will be liquidated. So I have some more questions. So I have some good questions from Sahare. So I'm sorry if I am saying the wrong name, but I'll talk about that strategy as well that you are mentioning. It is called as a collar strategy. So let me get to that in a few minutes. So now there's one more thing you can do. So let's say you have 100 shares of Tesla, right? So let me go back to example of Tesla. So let's say you have 100 shares of Tesla and you're willing to sell the stock at a price of $1,000. Right? So what you can do is, and let's say so what you can do is, let's say you're willing to sell it for $1,000 by January of next month. So what is the price for the call option with a strike price of 1,000? So that's $43, about $43. So what you can do is you can sell a call option with a strike price of 1,000. And for that, you receive $4,300 if you have 100 shares of Tesla. So now, if tomorrow the stock price of Tesla, not tomorrow, by January, the stock price of Tesla remains below 1,000, the person you sold the call option to will not exercise the option, because why will they buy it at 1,000 when the stock price is below 1,000? And that $4,300 will be a profit. But let's say this Tesla stock goes up to $1,100, you still will have to sell those stocks at $1,000. So that's the catch here. But let's say if you had bought Tesla at $500 and you were anyways going to sell it at 1,000, why not use a call option and make the premium? So I see it almost like it as you're placing a limit order to sell or a limit order to buy, but you're getting a money for it, right? You are when you're selling a put option, you're placing a limit order to buy. When you're selling a call option, you're placing a limit order to sell, and you're getting some money for it. And if that contract expires, then you do it again. You can keep on doing it. So I'll give you an example which did not work very well for me. So first I'll give you an example of covered calls. So this is from my portfolio again this morning. I have 1,000 shares of NEO. I bought them at a price of around $40. So now it is trading at around $35, $34. So what I did last week is I sold 10 call options contract for NEO expiring this week. So they're expiring on December 17th. 10 contracts minus 10. And I sold them at a price of 54 cents, which means $54 per contract and $540 for 10 contracts. So if NEO does not go to $40 by the end of this Friday, then I have a profit of $540, and I can again sell call options on Monday next week. So I'm willing to sell the stock at a price of 40 because when I bought the stock, the way I bought it is I had sold some put options. So again, I had made some money there. So now I got the delivery of the stock, so I'm willing to sell call option and make some profit there. So this is called as covered call option. Now you should never sell naked call options. So let's say I did not have NEO shares and I sold 10 contracts of NEO with a strike price of 40. So let's say for some reason by this Friday, stock price of NEO goes up to 100. Now I'll have to buy the stock from the market at a price of 100 and sell it to you for 40. So my loss can be unlimited if I sell naked call option contracts. So you should never sell naked call option contracts. So I'll give you another example of how it can go against you. So in February of this year, I was trading GameStop. Sometimes I do risky bets, like with small percentage of my money. Because premiums are very high in GameStop, I sold put options of GameStop contracts and I was making money like that. At some point, I got the delivery of 1,000 shares of GameStop. And the GameStop was trading at $45. So that week, I sold the GameStop call option contract with a strike price of 50, which means I'm willing to sell 1,000 shares at a price of $50. And the very same week, GameStop went up to $150. So I gave somebody the right to buy GameStop from me at a price of 50, which means for $50,000. And they were actually trading for $150,000. So if I would not have sold this GameStop option, I would have been $100,000 richer, right? So, but then I knew that my goal was to make premium and I was not trying to make money off of the chance that price goes up by $100 tomorrow. But yeah, you have to keep in mind that if the price goes up too much, it won't matter. You will still have to sell the stock at a strike price. So any questions here that I can answer? It's already 2:37. So the answer to Sarvana Kumar's question is, so strike price does not have to be higher than stock price for call options. So when you go here to Tesla here, you can see there are strike prices starting from 200. But the lower will be the strike price, higher will be the price you pay for that option. So I found a very good article actually that I did not write, but I'll put it in the chat if you're interested in reading. So this article talks about how you can make $100,000 every year by selling put options. So technically, if you look at my trade on SPY puts, if I could do this for let's say every month, so I made $9,000 from these SPY puts. So let's say if I had enough cash in my account to do this every month, I could make $9,000 every month. So that's like $100,000 a year, right? So you need to have capital to make money. And the more capital you have, I think more money you can make by selling these put options. But for those of you interested, this is a very good article on how you make money by selling put options. So yeah, I want to talk about how do you sell cash secured puts, how do you write covered calls. Then one thing I want to talk about is protective puts. So I think I briefly talked about that already, but let's say you have 1,000 shares of a particular stock. And that stock, let's say, is trading at $27. So the value of your shares is, let's say, or $28 is $28,000. But you want to hedge your portfolio. So you can buy option with a put options with a strike price of $27.50. So now you know that you can sell your shares for $27,500, even if the stock price goes down below 20. So this is how you can use put options to hedge your portfolio. Now, one question that I had received from this chat window is how you have a cost of $1. So that's like your cost. You're paying $1,000. How can you recover that? So Kushbu, I'm going to give you an example of how do you do a collar option strategy. So let's say you had $1,000 of Tesla. I'll go back to the same example. So 100 shares of Tesla. And you didn't want to sell them this month because you bought them, let's say, in June or something, and then for $500. And if you sell them now, you have to pay short-term capital gain tax in like April to CRA. So what you want to do is you want to wait till January. So you buy put option with a strike price of $900 because you at least want to make $400 per share. You had bought them at $500. So what is the price that you pay for that? So if you keep on scrolling down, you go to put, and then you go to strike price of 900, you're paying about $38 per share or $3,800. So now you're a little bit upset with yourself. Oh, I'm protecting my portfolio, but I'm like losing $3,800 for buying this put. So what you can do is when you're buying this put, at the same time, you can sell a call with a strike price of, let's say, about $38. So you sell a call with a strike price of 1,010, which is trading at $38. So now the money that you spent on insuring your portfolio, you recovered it by selling a call. But what is, again, the risk here? If the stock of Tesla goes above 1,010, you will still have to sell it for 1,010. But the great thing is you have insured your portfolio for zero cost. So the $38 that you paid for buying the put option, you have recovered by selling a call option with a strike price of $1,010. So this is called as a collar strategy. So I had a question in this chat from, I forgot. So there was a question here earlier that how do you recover this cost of buying put option? You can recover it by selling a call at the same time. So that is called as a collar strategy. So I'll go to the slide here. So collar is an option trading strategy. It is bracketing the value of a portfolio between two bounds. So for example, here, if the stock price of Tesla went to 600, you can still sell it for 900. So the lower bound is $900. But if it goes up to 1,100, you still have to sell it for 1,010, which you're okay with because you had bought it for 500. So you don't mind doing that. So does that make sense to you, Khushbu, a collar strategy? I cannot hear you, Khushbu. Your mic is muted.
Or I think that's the most common use. I was on mute. Yes, that does make sense for me to have the collar strategy. Thank you. I think I'm most interested to say, if on a regular basis, I have, say, $10,000 as something I can risk and experiment on, say, a new stock, that there isn't enough information for me to have clear direction on, then these are some of the strategies that I can potentially use. And this is one of them, where I know that I have bounds on both sides, so that if for example, I wanted to try a Moderna stock, which I did, by the way, about almost 2 years ago, before they had the vaccine. But I was so scared that instead of investing a lot, I bought like a few shares. And now they're like extremely in the money, except I didn't have the money or the guts actually to go big on them, even though based on the research, seemed like they were onto something. Something like this would allow me to say, okay, I am kind of aware of what Moderna is doing, but there is a certain amount of risk. So let me play in it in a bigger manner without having to buy a ton of shares.
Yeah, and also I would say that for retail investors, it's hard to predict the direction of a stock in the short term. So if you buy an call option for Tesla with a strike price of $1,000 that expires next month, the stock may not go to $1,000 next month and you lose your money, right? So to predict the direction in the short term is hard. So that's why I don't buy short-term options. But what you could do is you can buy leaps. So leaps are options that have maturity of more than 7 months. So if you think Tesla will do well, you can buy an option that expires maybe 2023 and use leverage that way. You can definitely do that, yeah. So there's a question that, are there resources you use to determine the right strike price? So I'll tell you something about in the money and out of the money. So there's a slide on that I will.
While you were answering that question, I will kind of like jump on the same bandwagon on resources. So Professor Jain, like if I weren't somebody from this area, or I wasn't somebody who had data-backed opinion on which way the stock would go. So not somebody who's done like a financial analyst or a Wall Street analyst who's done an analysis and said, okay, I am expecting the stocks to go in this way or that based on fundamental analyses, right? Then how do I determine which way, are there some easy checks to make sure that I'm not buying a lotto ticket, basically? I'm actually buying something that has some credibility. What are some quick checks? Because a lot of us may not have the time or the capability to actually do a fundamental analysis and make a data-backed decision on to the question and used what is the right strike price, which way do I think it's trending. It shouldn't be that I feel like this is going to trend up or I feel like it's going to trend down, but some basic ways of checking to say, okay, based on this, my conclusion is this, and maybe 50% of the world agrees with me and 50% doesn't, and that's okay. But it shouldn't be that I'm anti 99% of the world. I shouldn't be way off, and it shouldn't become a lotto ticket.
Yeah, so I would say that you look at stocks that you're willing to hold in the long run. So like Spider is one. So for example, I have like PayPal in my portfolio, and I don't mind buying PayPal, right? So I'll go to PayPal and I'll look at PayPal's stock price today. It's $187.22. I don't mind buying it at $185. So I'll always sell out of the money puts. So which means out of the money put means the strike price is less than the stock price. So if somebody has the right to sell it to me for 185, that option doesn't have any intrinsic value right now. The only value it has is what if over time it goes below 185, then they can sell it to me for 185. So for put options, the strike price less than the stock price is called as out of the money. For call option, the strike price higher than the stock price is called as out of the money. So what I do is I sell out of the money puts, which do not have any intrinsic value. The only thing it has is time value of money. So then that decays over time. So for example, going back to my slide here, the example I had on Spider options. So Spider was trading at $450 when I sold this put option. So the put option with a strike price of 400 was a deep out of the money option, which means if somebody's buying a right to sell put option Spider at 400, the Spider has to go down by 50 for that option to have any intrinsic value. So this is a deep out of the money put. So when I sell this, so all that $9.23 was the time value of the option. There was no intrinsic value. And time value of the options decays over time. So like when I sold this option in September, people were willing to pay $9 for this option. Now it is December. Chances that Spider will go down to 400 are much lower. The time remaining is only a month. So that option is only worth $1. So these are the money options, the premium that they have that decays over time. This is called as Theta Decay. So I'll not go into the Greek letters, but, and I would say the strike price that you choose is the price at which you're willing to buy it. So if I would have sold Spider put option with a strike price of 450, I would have received a much larger premium because that option will be like, so for somebody that option has more value, they have a right to sell Spider to me for 450. I've received a much higher premium, but then I'll have to buy Spider at 450. So it depends on what price I'm willing to buy that, right? So same is true for selling covered calls. How much money do you want to make from your capital gain? Or all the money you're trying to make is through selling options. So again, that's a question you have to answer. So the strategy that I'm talking about, it is called as an option wheeling strategy. So basically what you do is, if you are bullish on a stock, so it's easy. Like let's say you're bullish on Tesla, or let's say you're bullish on PayPal or any Moderna. So you sell put options for that stock, which are out of the money, which means they don't have any intrinsic value. And then if that stock goes down below the strike price, you will have to buy the shares. And once you buy the shares, you again sell covered calls. So you're not trying to keep the stock in the long run, you're just trying to make money off of the premium. And the strike price of the covered call, that you can decide. So let's say, for example, I had sold Moderna puts with a strike price of 250. And it gets assigned to me, Moderna goes down to 240, I buy it at 250. Now I can sell covered call with a strike price of 300. So then I make premium as well as the price gain of $50. So that's up to you, like how much capital gain you want to make from selling the stock, and how much premium you want to make. So the premiums will vary based on the strike price. So a call option with the premium, with a strike price of 300 will have a lower premium than a call option with a strike price of 250. So again, you can play with all that here. So you can go here and you can see how the premiums for call options vary with strike price. So higher the strike price, lower is the premium. And then again, you can see how they vary with the expiration date. The longer the time you have, the more will be the value of the option, because higher the chances that option can give you a payoff. So that's how. So I think it's almost time now, but Kashbu had like many slides. I had slides on like bull spread, bear spread, and like straddle, strangle, butterfly. I think I'm going to skip all the bills today.
So. I think let's open it up. Let's open up the floor to audience to see if there are any questions specifically on the stuff that you've already covered. I know I did learn a lot, and I have regrets on not having Moderna, which I wish I had used an option trading strategy for, given how well it has done. But let's see if there are more questions from the audience.
So one more thing I wanted to say is, by looking at these put and call volume, you can also see the sentiment of the market.
Yeah.
So if you look at the volume of put options being traded and call options being traded, if the ratio of put to call is greater than 0.7, that means generally investors have a bearish sentiment for that stock. And if the ratio is greater than less than 0.7, that means the bullish sentiment in that stock. So you can also make deductions on the sentiment of the stock using the volume of these options.
But my worry with that, Professor Jain, is like when you look at these ratio and you're talking about sentiments, GameStop was a different game altogether. If you looked at sentiments with that stock, you wouldn't be able to make the right decisions just because where it was headed was not as fundamentals backed. We actually have an audience question. Which platforms do you use for trading?
So I use Interactive Brokers, and I'm like in the US. So Interactive Brokers give you the lowest interest rate for margin. So when you borrow money from your broker, usually margin rates are 8 or 9% interest, which is quite high. Interactive Brokers give me 2.5%. That's why I use that.
Maybe we change that question for, we have audience from US and Canada both, to what are the things that you should look at when deciding to go with a trading platform?
Yeah, so one thing I look at is definitely the reputation of the broker, because sometimes the outages, like when there's a lot of trading happening, some brokers may have an outage. You don't want that. And also you want to make sure you get the best execution price, because let's say if you place an order to buy, and because if your platform is slow, by the time the order reaches the exchange, the price might have moved. So you definitely want to look at a broker with good reputation. You don't want to go with a small broker. But if you are going to be using margin, you want to look at the margin interest rates. So that is important for me. So I use margin. So look at the margin rates for all the brokers. In the US, Interactive Brokers has the lowest margin rates. You can look at the margin rates, what they are like in the Canada as well, and figure out which is the best platform for you.
Yeah, I mean, that's quite helpful. I think in the real estate context, from where we are, there are two ways we see options trading becoming relevant. One is you can always use it when you're talking about REITs and you're buying REIT stocks. And for those of you who don't know what REITs, I'm guessing all of you do, is real estate investment trusts. These are publicly traded stocks of basically large pool of assets. So unlike our platform where you are investing deal by deal, you're investing in a portfolio of properties. So REIT stocks is where you can apply option strategy all the time based on whether you're bullish or not bullish on a certain segment of real estate or not. And then the second place, something that we as buy property would want to bring is the rent to buy as a first-time home buyer. And that's something that we as buy property would want to bring to our platform, which is giving people the option to buy a house 5 years from now by paying sort of like a call option, where you have the option to buy a house in 5 years from now by paying an extra price right now at a predetermined exercise price. So you're kind of hedged against the market, which has been going up quite a bit.
So you are going to be using options in like they'll be called as real options, right? So you're giving options to investors to buy a house if they decide, and then they save on the rent they have paid. Okay.
So they basically pay more than market rent, which is the price of the option. If they don't buy, then I get extra rent, and they don't have to pay the market price if the market falls. If the market doesn't fall, then they are able to buy at a predetermined price. If the market goes up, then they are in the money. If the market goes down, then they don't purchase, they don't use their option, but these still are okay because we got extra rent over time.
Yeah,
so it's kind of a win-win setup. And we are looking to launch something like that for first-time home buyers.
Okay. So I've also put down my email address here in case somebody has questions, or I can email these slides to you if you're interested. I could not go over the material that I had here.
Yeah, this was a lot of useful content, and I hope the audience learned at least some stuff from this that we are doing.
But I'll just give you advice not to take too much risk. So like, again, it can be very easy to start taking risk, because you think, oh, let me sell more options, I'll cover my loss if something happens. But at times, your loss can go up very quickly. So yeah.
So since we are coming to the end of the year, I had to ask this question of the audience. Are you planning to take steps in the next 12 months to help your money work harder? Because that's something that we at Buy Properly are constantly helping people make decisions, which is why we bring such educational webinars. There's a question from Naveen, meanwhile, while we wait for people to respond. What's the risk to reward ratio you aim? I don't know if it's a question for you specifically.
So like, I'm not like running a fund here. So I do not like calculate my Sharpe ratios and stuff. So I just try to earn the highest dollar percentage return I can, So I do not like calculate what is my risk adjusted return. I do not do that.
But what strategy you use to decide how much you will play with? So if you are going to venture outside of standard conservative risk strategies or taking on something new, is it a percentage of your net worth or a percentage of your income that you set aside to invest in some of these strategies?
So yeah, I primarily mostly just sell options. I do not. I've not been great at buying stocks for long term, although I've done well in a lot of different things like crypto and real estate. So I primarily all of my portfolio is based on selling puts and selling covered calls. That's what I do. Yeah.
Awesome. Well, thank you, Professor Jain, and thank you everyone for attending the session today. I hope this was useful, and if you aren't already subscribed, please subscribe to the Buy Properly social media as well as email newsletter so that you keep getting information around what we are planning in the new year. I can promise you we have some very exciting sessions in the new year as well. Thank you, everyone.